Definitely, we want to say happy Sunday to everybody. Hi, everybody. We are live on YouTube right now as we're going to start our series, Invest Your Way to Financial Freedom. Today is June 7th, guys. This is the fifth video of the series. So, this is also our last video of the series. It's been a good journey. It's been a very fun and very informative, and I've learned a lot to the story, not only about my flaws and things that I'm supposed to do in investment I'm doing, but I wish I somebody out there is actually learning from this series. Again, if you are not sure about the series, we have it all on YouTube, a 15-week series. So invest your way to financial freedom. So yeah, so as we say in this series, what we do is we show you a simple investment framework based on maximizing your income while reducing your expenses to produce a net positive net income. And with that, you want to put part of it, you directly invest in the market, liquid asset, and part of it you invest combined with good debt so you can get into a liquid asset like real estate, stuff like that. So again, all this is being out there, guys. This is our last series today. And if you don't know me, I'm El Bozo from Combit Group. Our mission is simple. We want to simplify the business and investing world so you can become more educated financially to invest your way to financial freedom. We want to inspire the next generation of investors. So if you want to take your investment journey to the next level, no hype, realistic strategy, make sure you subscribe, like, follow us anywhere you watching us on YouTube, on TikTok, anywhere. You can definitely help us, grow this community of next generation of investors. We're gonna go straight into it. Again, if you just join us, this is your live invest your way to financial freedom. This is the 15th video, guys, where we've been for 15 weeks. We've been talking about investment, how to make money, how to be educated, and this is our last day of the series. And we're about to close the series talking today about a other type of illicit asset, because we spend a lot of time talking about real estate, but today we're going to share with you other type of investment you can do that illicit asset. So but before we do that, before we get into the topic today, as usual, we always share with people what happened last week, big news that happened last week, and big news that we're gonna focus on next week as investors. And also, we share with you three stocks that's worked for us this week in our portfolio, so you can maybe look into them and see if they might work for you. So it's all about information sharing. We're here to build a community of new investors. So now you guys don't have an excuse. I always say the time to victimize yourself, thinking like life is not good for you, thinking like you don't have nobody to help you to kick off your investment, it's over. Because guess what? Now you have 15 video, guys, that we break it down. We've been breaking it down for 15 weeks, guys. All the investment knowledge that you need to start investing in your journey. So definitely stay tuned. Check our YouTube channel, guys. This is where we post all the videos, guys. Again, this is investment, this is business, this is not a joke. The time when you think like, oh, I didn't grow up in a rich family, oh, I'm so behind, or I hate my job, I don't know what to do with my life is bad. Guess what? I've been there. I see a lot of people who come from a disadvantaged family. They sit there around and complain that life didn't give them the best outcome. But guess what? I've been there. I have transitioned to the fact that, you know what, rich people, I learned that rich people, they're not smart, they smart everybody out. So what I did is I start learning, and that's why I'm sharing with you guys so we can help each other. So if you're here to learn and build something for yourself, just stay tuned. So now we're talking about what happened last week. As part of our format of the series, we always talk about what's happened in the past and also what's going to happen in the future. So make sure that we position ourselves. And we always come, especially, we always start with reviewing what happened last week with the war in Iran. So as far as today, June 7th, the US and Israel conflict with Iran remain active despite the ceasefire announced in April. Tensions still remain very troubling, and you see this weekend, there's like report that the US is attacking Iran, and guess what happened? When those things come up, we're gonna see that reflecting in the market, guys, because oil is tied to inflation, and that's what you see. The price of oil, as far as today, it's about 81 dollars. It's coming down from 120 it was from the beginning of the conflict. So now we are like about $81. It spiked, because there was a lot of active problem this weekend in the Strait of Hormuz. We're expecting next week coming up, there's going to be more tension. So we're expecting it, even if it's $81 right now, the price of oil, it might go up. And the average gallon of gas in the US, it's about $4.17, which is like, very low compared to the $6, $7 that I was hearing. That's a lot of people were talking about, but we see like it going down. And that what that means for inflation. Inflation might be going down a little bit too. So we got to watch what's going on this week and see if any indication that the inflation will go down as price of oil is going down. So now, as a review, like when it comes to what happened last week, we're looking at Monday, for example. Monday we have the PMI, industrial manufacturer, a PMI, which is like that's measure the health and direction of the U.S. manufacturing sector, and it's considered a key leading indicator for the broad economy. What happened to it? And that day, we see like a report reveal like a surge in U.S. manufacturing activity for 4 years high, driven primarily by business front loading orders due to supply chain fear, geopolitical tension, and surging inflation. So definitely PMI went up. We had been concerned about that. That's mean like inflation is ticking. So when you have high inflation, remember the Fed is not gonna cut. They might wanna hike. So they might wanna go up. So that's gonna cause problem in the market. And we already see the volatility going to the week, how bad it was, guys. The stock plunged because there's a lot of volatility going on, a lot of problem in the market right now. And we're gonna talk about it. And if you look at what happened on June 2nd, Tuesday, what we got? We got job opening report. So it's one of the favorite Fed labor market indicator. What did it come out on June 2nd? So the report saying like the US job opening unexpected a surge from 7.6 million for April. So you have a good market. When you have a good market, guys, that's why I want people to understand. They always talk about good news and bad news. When you have a good report market, as investors, we don't really like that because we want to see the economy struggling, which is selfish. I don't know if it's just a selfish thing for investors to be thinking like we want the labor market to be bad so the Fed can cut so we can invest. But again, listen, me, I'm not here to judge the economy. I'm here as an investor to follow where the money is. I'm just here to play the game. Is that a good thing? I don't know. But because of the US job market was positive and good, guess what happened? People start shaking because they start thinking about the Fed gonna hike because now the Fed don't want to go down because if the economy is doing good and better than expected, the Fed gonna cool it off. So that's why you expect a lot of people were talking about the Fed might really hike the economy. And also, if you look at Wednesday, what happened? You have employment report, right? The private sector payment estimate, the ADP report estimate how many jobs they add in the US. So what happened? It's revealed that the US added about 122,000 jobs in May. So this exceeded the Dow Jones consensus estimate that was they were thinking it was about like 110,000, but because of that, they added more job. Again, the economy is still resilient. Then guess what? People start shaking. Investors start pulling off because they worry about the Fed kind of hike. So then they cannot buy that much, so they cannot invest. So when the economy is doing good, guess what? Investors are pulling back. When the economy is going bad, investors are going in. So it's a very weird relationship when it comes to investing in Fed. But again, that's what part of the economy. That's how the economy works. And you see that reflect, for example, on Thursday, jobless claim weekly job. It's a high frequency measure to labor market health. And you see that the US initial job claim to the week ending in May 30th was unexpectedly by 13 to a seasonal adjusted to 25,000 job. This market this marked the highest level of first time unemployment feeling since early February. So, what the impact? You see the bond and rate sensitive sectors could move significantly. So, definitely, everything play a role in the economy, guys. And lastly, on Friday, what we will see, we see like this, the U.S. non-farm payroll report. It come out saying like the U.S. labor market demonstrated surprising resilient in June 5th. So payroll in 2026 in June 2026 showed that the economy is adding 175,000 job. Again, this all job report. It was all the week was all about job report, guys. And guess what? You see the market tremble. The market fell because what? The economy was resilient. The economy was doing well. And we were looking at everybody was talking about, oh, it's gonna be a pullback 20-25%. And we see that on Friday. That's why we as investors and Commit Group, we have to downgrade. We have to move, diversify, go to those sectors that was really from sectors that was really inflated, like stock, a technology, go to other sectors like bank, and we see like investors were rotated toward bank and also, for example, healthcare, stuff like that. So we definitely had to recalibrate our position in those sectors where we invest. So that's what happened. The economy, when those stocks go too high, they're gonna have a pullback. And if you're not careful, you might lose a lot of money. So we had to rotate and diversify this week. And that's exactly what happened on Friday. We see the market plunge and we had to quickly exit some position and we focus on other sectors. And that's what you got to do, guys, because in general, when I'm talking to investors, they were talking like, oh, every time like they have something good going on, they wanna just like get out. No, you don't just get out. You get out strategically. You move to other places. When your stock that were doing good are not doing good, guess what you do? You're buying the one that's going good. It's simple, guys. You follow where the money is going. So, so definitely we are looking at what's gonna happen. A what's gonna happen for now. We're gonna look for what's gonna happen the next week. For the next week, which is tomorrow, for example, we are looking at Monday the 8th. What the more important information that's gonna come out is the a New York Fed consumer inflation expectation. This a data measure what consumer expect inflation to be over the next year or longer term. Rising inflation expectation can make it harder for the Fed to cut rate. So on Monday we're gonna have Fed coming in and they're gonna start talking about what do they think about the economy. So that's why we have to pay attention as investors. We definitely want to pay attention to what those Fed are saying. So Monday we're gonna have a the New York Fed consumer inflation data. So and follow that on Tuesday. The most important thing investors need to pay attention is the U.S. trade balance report for April. This show usually the difference between U.S. export and import. So it can provide clues about economic growth and international demand. So you got to look into those report, guys. As investors, I always say that you got to do the work, guys. Don't just count on the news and people just talking. You got to sit and read the report, at least listen to the analyst, credible analyst that's gonna give you their intake, honest intake, so you can learn. So we're following that on Wednesday. What do we see on Wednesday? On Wednesday, we're gonna have a most important day of the week. You got the consumer price index (CPI) is coming out. So as a CPI, CPI is an indicator of inflation. If CPI is hot, guess what's gonna happen? The Fed is not gonna cut rate. That's why we're gonna take our time and read the CPI report. Us and Compete Group as investors, we have to. And also, we're gonna following that on Thursday, we have the PPI, which is the Producer Price Index. What is it? Producer Price Index, the PPI, measure inflation at a wholesale business level and often provide clue about the future consumer information. So May PPI report will be released at 8 a.m. on Thursday. So we definitely want to pay attention to those report, guys. We also have on Thursday a weekly indication job claim. So it's provide real-time look at labor market strength. So this week, I can tell you what's going on in the market the following week is all gonna be about inflation. It's all gonna be about a what we wanna see in the market when it comes to inflation. And lastly, on Friday, June 12th, we have the University of Michigan Consumer Sentiment preliminary June reading. So this is like usually it's a survey where show consumer confidence, inflation expectation, spending intention. So as investors, we are paying attention to the Michigan consumer sentiment data. So again, it's all about knowledge, guys. As investors, you got to do your job. So now, part of the series, we're gonna shift now gear. We're gonna talk about our three best stock for the past week that just passed. I can tell you, those are the stock that work for us at Compete Group. We are not telling you to buy the stocks. We have to be responsible as investors. We are responsible investors. What we can tell you is that those stocks have worked for you, for us. Maybe they work for you. You're just gonna have to do your work and see if they can work for you. So this week, it was, I can tell you, it was a very, very tough week for us at the end, starting from Thursday, Wednesday, and to Friday. We see the market start plunging, giving us signal that there was a downturn. Guess what? We had to recalibrate, and the stock market fell very hard on Friday, and it was very hard for us to even find a good stock this week. But the only one that really came through for us this week was, I can tell you, was Marvel Technology, which is a technology company, Marvel company. So this company, it went up for us for 30% this week. But guess what? On Friday itself, it went down 16%. So it was telling you that at the beginning of the week, it started very high and then it fell. So that was a lot of volatility in the market this week. I can tell you, I've been investing for a while now. I have those week like this week that just passed that I'm like, wow, you can see the market, you're making so much money, and 1 second you're losing so much money. It was very, very volatile. But guess what? As investors, we got to always stay focused. When the volatility, it could be time for us to make money. So a lot of people run away when there's volatility. But if you know the market, you know that volatility can be a source of very high gain if you stay invested, if you know what you're doing. And that's why we encourage you to always educate yourself. at the end of sorry, at the end of the day, it's all about education, guys. You cannot win if you don't know what you're doing. So you need to be educated and know when to take those positions and those shortcut. Sorry. Now we have also the second company that worked for us this week was Walmart. You know, Again, Walmart was up only 3% this week, and we are very happy. We are very happy. At least some of the stock that went down. I think Walmart was probably one of the only stock that really was going turning up, because almost all our stock this week did very bad, and it was very hard to find even positive. The one that was positive during the week, Walmart came out for us. It was 3% this week. So the last company that did well for us was JP Morgan Chase. The ticker is JPM. It went up 5.5% this week. As you see, because of people are getting scary of a problem in inflation, and the labor market is going strong, you see investors rotate from technology stock into financial stock. During the first week of June, money flow out of some high growth tech name and into bank and financial company. So again, as investors this week, we want to look at the banking sectors. Are they making money so we can take position in them? And as far as I know, that market is investors are telling us that they're expecting like a 10 to 20% a correction in the market in this summer. There is a sign that it's already started, but how far it's gonna go, We don't know. But at the end, we're not there to time the market. We are there to play the game. If the market is telling us to sell off, guess what? We are buying. If the market is too high, we are selling. So stay invested, guys. Be disciplined. Don't get panic and start going crazy when the market is going down. So now let's go through what we hear today. What we're talking about today is the topic today is about a liquid asset. We're finishing what are different beside real estate as a liquid asset, which is very common. There's other asset out there we want to share with you. It doesn't need to be all as far as long term goals. It doesn't need to be all real estate. So that's why we want to look into some of the other illiquid asset, which is if you don't know what illiquid asset is, make sure you go back and watch our series. This is our last at this point, if you're watching our series, you will know what a liquid asset is. A liquid asset, to refresh your mind, is asset that you cannot quickly sell, and convert them in cash without sensational loss. So definitely you want to look at, what are other assets you can plan long term that's not involve real estate. For example, other illiquid asset beside real estate can be, for example, private equity. What is it, private equity? It's ownership stake in a private company or startup that are not publicly traded or on an exchange. But as common investors, people think like, investing in the market is the only way. No, actually, private equity, there's a lot of people are making a lot of money in private equity. That means you just go and buy stake in private companies. Also, you can invest in collectible and art. Art is like a tangibly luxury good. Like like, for example, fine art, antique vintage car, and rare coins. Those are type of investment you can invest in, but it's very difficult to sell them right away because mostly it's not like a stock. You can just press a button, you sell. That's what they consider illiquid asset. You also have private credit. For example, private credit is when you go direct loan or private debt in an instrument that lack an active secondary trading market. So definitely you can look into private credit. You also have what we call venture capital. So what venture capital, what you do is you invest the money, you lock up long duration investment in early stage of a business. So you a very startup business, don't know what they're doing yet, but guess what? You take a leap of faith. You still got to understand what market is. There's a big thing, a important thing you have to consider when you come to venture capital, but it can be very rewarded. The can be very high because those people are very started. They probably don't know that much what they're doing. But if you're lucky, you do your research and you might go big. You invest, for example, in a small company or starting like $1,000, you can become a millionaire like this after a while if the company do well. So that's why a lot of people who have a good appetite for risk, they go into venture capital, and a lot of them make a lot of money. Other type of liquid asset beside real estate can be operating companies. The majority owner stake in a private business that requires significant time and value and sell. So you might just like open a business, and co-partner with a business. That's operating a company. It's not like you can easily sell it. So definitely this is considered a liquid asset. You can tap into it. Also, physical asset. You can specialize manufacturing equipment, heavy machinery, long-term tangible assets. So you can buy those, like for example, a truck company. You can build your own truck company. That's a physical asset. But guess what? It's not that easy, quick. You can sell those assets in one day. So definitely those are considered intangible long-term asset, physical asset. So now I want to go quick, tell you about step that you can get into a some of the liquid asset like private equity, right? So let's talk about it. What is private equity? So private equity is definitely, like we mentioned, um, it's when you own a stake in a private company. And first, if you want to get into it, what you want to do is, as any other investment you're doing, you're going to define your investment goal, determine your target return, decide how long you want to keep your money invested, assess your risk tolerance in liquid asset. So definitely you want to do your research. And the second thing you have to do is ensure you meet eligibility requirement, because a lot of those private company guys, what they do is like They have some crazy regulation. For example, some of them might want you to be accredited investor. If you don't meet some criteria, you don't have some money, they might not want you to be. You cannot invest in those companies as much you want. Some company might require you to have, I don't know, $5 million in the bank guaranteed before you can even invest in their company. So you have to make sure you look at what the criteria is in order for you to invest in this company. They usually, private equity, lean to high net worth individual, HNW. So definitely, if you're not high net worth individual, you might struggle to get into private equity. And also, they target institutional investors. Those are like, some companies, like if you own, I don't know, another company, financial company, you might be easily invest in those private equity firm. Also, the requirement may vary by county, by state, so by business. So definitely, you want to make sure you meet the requirement first. And the third thing you can do if you want to get into private equity is to build your financial foundation first. As we always say, make sure you maintain an emergency fund, pay off your debt, diversify your stocks and bond and real estate, limit private equity exposure to a reasonable percentage of your portfolio because it can be very tricky, guys. Private equity, it can be very, tricky because in private equity, things can when things go bad, you on your own. Technically, if things go bad, it's always gonna be in you're always gonna get in trouble. Compared to some part of the market, for example, some regulation they still have to abide to it. If something goes wrong, you're still gonna get people accountable. It's easier because you have more oversight, more regulation when it comes to that. So definitely make sure you're looking into your finance before you start investing in private equity. And the fourth thing you do, you have to choose how you want to invest. For example, in private equity, there are different ways you can invest. I'll give you a couple options. So option A is private equity fund. So what is a private equity fund? You can just, if you meet the criteria, you can apply to become an investor in a private equity funds. What is it? It's a fund managed by professional firm like BlackRock, KKR, Apollo Global Management. So provide diversification across multiple companies. So those companies, they create a fund and then they invest in multiple companies. So you got multiple investment in different businesses. That give you a little bit a better chance of winning because you have a good diversification exposure. Another option for you to invest in private equity, which is private equity ETF and publicly traded firm. For example, you buy a share of a public trade private equity company into a brokerage account. So it's more liquid than traditional a private equity fund. So definitely it require more money to do like those type of a private equity ETF and publicly traded firm. And the third option is private company investment. So invest directly in a startup or private businesses, high risk but potential high reward. So that option is private company investment. It's definitely almost like kind of investing in a startup, like a venture capital style, but it's still called a private company investment. So at the end of the day, what we want you to do is perform your diligence. Make sure if you're gonna do that, if you're gonna invest in private equity, you wanna make sure you check the record of the fund manager. What are the record? Are they like being in different companies, do something wrong? You don't want to just go invest in company not knowing who's managing your money. So look into the investment strategy. Is it strategy aligned with what you're trying to do? Are they like short selling everything and move on, or they are long term build up? So is it industry focused? Some private equity focus on certain sector. Historically return. Look at the data. What are the return historically? The fees. That's very important. A lot of people are investing, but they don't look at the fees and expenses those companies are doing. Especially right now, we are looking at people are just like buying stock and going crazy, but they forgot there is a lot of spending that's going on and the return doesn't match. So that's why we got to be careful out there. And also, when you buy those share in those private equity, you lock up for a certain period. Is it the share that you're buying in those companies? Is it match your retirement goal? Is it match your short-term goal? So those things you have to really take in consideration. And also one also thing that you have to take in consideration is that understand the fee structure. So for example, for typical private equity fees, you have management fee 2% annually. So those people are taking a fee for manage your money. And performance fees. So that means if they perform good, guess what? You pay them 20% of your profit. So if they make you make money, they take 20% of your profit. Always review fund documents carefully. I see a lot of investors out there. You guys are not reading. You guys are not looking at your. Why are you not checking your balance sheet? Why are you not checking the report those companies are putting out there? So I don't understand it, because guess what? Those fees are gonna cut down your profit, and you really need to understand them. And also, one other things that if you are investing in PE, you're gonna look at committed capital. So a lot of have very high sign up bonus. Fund generally call capital over time rather than taking the full amount immediately. Be prepared to provide additional capital when requested. So the private equity might want to ask you to give you them more money to invest. So you got to be prepared. So that's why I will say to you, private equity is not for you if you're just a regular investors, because it require a lot of things more than like going in the stock market and buy. That's why this is more like they do this for the big boys. This is not like little beginner investor. We're talking about when you start growing your portfolio, you want to look into private equity. But also you want to monitor performance. You're going to track the performance. We say that every time, every month they do their report, you got to look into the cracks. What are they doing? Portfolio a company updated, distribution payment, change in economic condition. All those factors got to be into the report, and you got to be paying attention to them. So also, one of the most important thing for me that you need to consider when you investing in private equity, it's the plan your exit. you know Return are typically realized when a company is sold, a company goes public or from an IPO, or the fund reach the end of life and is distribute proceed. So definitely your exit strategy have to match the exit strategy of the manager, whoever has managed the fund. So that's why you need to take your time. If you're gonna invest in those funds, look at what the exit strategy for the fund. If it doesn't match yours, you might not wanna invest in it. Thank you so much. I see in the live a lot of heart. Thank you so much for being live. I see Dana Carrera. Thank you, thank you. I see a lot of people are on the live. We appreciate it. I see you guys being on the live, and we appreciate it. Again, my people from Mexico, we love you guys, and shout out to Mexico. I know some people are watching me from Mexico right now, and thank you so much. Again, we continue. So we're talking about private equity. So beginner friendly way to start. As a summary, if you are new in private equity, consider investing in public traded private equity firm, using alternative investment platform, join private equity focus and interval funds, gradually increase your exposure as your portfolio grow. I don't want you. Thank you, Erandi, for this beautiful heart. We appreciate it. For my people who are listening from Mexico, we love you guys. Um, I just want to say, if you're gonna start investing in private equity, you gotta go slow, guys. You don't want to go and spend your money. We always recommend slowly grow your portfolio. So key risk, illicit asset, money may be locked up in few years. High fees can be accumulating. Economic downturn will affect your portfolio. Business failure risk. If the business go under, it is most likely you're gonna lose your money. Limited transparency compared to public stock. So as you invest in private equity, guys, they don't have to disclose as many things that they disclose in if you are a public company. So a lot of those things are catchy. They're gonna use certain term. They're gonna be kind of be more private to get more information. So definitely, I will say if you wanna do a portfolio allocation for a long-term investors, I will say you can look at into if you wanna go to public equity world, you can do 60 to 80% public stock, 10-20 to real estate, 5 to 15% private equity, and then you keep 5 to 10% cash and bond. So private equity can be powerful wealth building tools, but it's worked best as far as diversified portfolio and for who leave capital investing in many years. So private equity can be a long-term satisfaction, guys, if you keep your money long-term goal. Thank you so much for being in the live again. I see a lot of heart going on in the live. We appreciate you guys for being here. Again, this is your series, Invest Your Way to Financial Freedom. This is our last day, guys. This is our last day. If you haven't seen the series yet, you gotta go on our YouTube channel, guys. El Bozo Busando. Make sure you're watching this. This is it. This is your last chance to learn. So if you haven't learned yet, you have 15 videos to learn everything you need to start invest your way to financial freedom. So now we're gonna shift gear. We're gonna look at a second type of investment, a liquid asset, which is collectible in art. You know, I myself, I always question why rich people are investing in art, but then I realized, as an illicit asset, investing in art and collectibles can be a good way long-term build up of wealth. So investing in collectibles and art can provide diversification and potential long-term appreciation, but it's require research, patience, and risk management, guys. That's why a lot of people who already have money, they keep their art because it's not like you just have an art in your house and next thing you can eat. Then you're gonna have to sell it. It doesn't work like that. That's why you keep your art for a long time. The longer you keep it, the value will go up. So definitely, if you have some extra money, I would say yes, definitely invest in art. Again, thank you so much for being in the live. Angelina Carrera, thank you so much. We love you guys. Thank you for being in the live. I see Erondi thank you so much. Manuel, thank you. Migayo, all my people from Mexico, thank you. I know you guys are on the live. I'm hoping that you guys are learning a lot. I'm learning a lot about investment, guys. Thank you, thank you. Yeah, so we want to talk about how to start investing in art and collectible, guys. First, I will say, sit down. Hola, Mark, Gramar. Hola, hola, hola. ¿Cómo están, mi gente? Thank you so much for all the like and the heart. Yeah, so if you want to invest in collectibles and art, we want to start first. Choose a category. Art is, I would say, is very specific. You have to find what you good at and what you're interested in. So you want to focus, maybe it's fine art, sport, memorable. You can use card. For example, Pokemon card. I know a lot of people who invest in Pokemon. I think one sold by Jake Paul or one of the poor guys for $15 million. A Pokemon. Imagine. Those are valuable. Those are illiquid assets, but they're valuable. Yeah, world coins, watches, a lot of vintage cars, wine and spirit, comic book, you name it. There's a lot of way you can invest in art and collectible, but you have to start in one. That would be the first step. Think about what you like. Um, and Felipe, Andrade, everybody, hola, hola, mi gente, gracias, gracias por escucharme desde México. Thank you so much for being here. We love you guys. So yeah, so the second way before you choose what category you want to invest in, what you want to start doing is learn the market. So before buying anything, study historic price trend. Before you buy something, hola, hola, Angelina Carrera, gracias, gracias. So before you invest in anything, what I will do is I will definitely looking at the market. Study what it is the price is, follow auction result. You might want to go to auction. You might want hola hola comadre. You might want to go to an auctions. You start understanding what drive the value. Is it a rarity? Is it condition? Is it provenance? Is it demand? So join collectors communities and forums. So definitely you wanna join the forum. Again, thank you so much. Thank you so much, Dana Carrera. Okay, we love you guys. Thank you for being here. So I'm getting a lot of love in the chat. I see a lot of people from Mexico. Hola, 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 Mexico. ¿Cómo estamos? Hey, thank you so much. So yeah, we're talking about learning the market. learning the market, guys, you have to do your research. And the third thing you do is start an investment budget. So to start an investment budget, you want to know how much capital you want to allocate. Whether you're investing for 5 years, for 10 and 20 plus years, then you're gonna build a budget based on that. How much liquid asset you're comfortable with, you know? So many experts suggest a collectible is about like 5 to 15 overall percent of your portfolio. So if you are building a portfolio right now, you want more exposure using a liquid asset like a collectibles, I would suggest, follow about 15% of your portfolio. If you're starting, I will start about like 5%. Me personally, I've been investing in collectibles. I will say my collectibles a portfolio is probably something about 2 to 3% of my overall portfolio. At Combi Group, we don't really do too much collectible, but this is something we are looking at. Again, oh, gracias, gracias, gracias. Thank you for the heart. Thank you, thank you. So definitely the fourth thing you want to do is buy from a reputable source. So when you start like now, you're ready to invest, you do your research, you got the money, you already set it up, and then you want to do major auction houses, established galleries, certified dealers. So in collectible, you have to be certified. When you're certified, dealer, so it's very important authenticity because you have to have graded, registered, and always verify authenticity of and ownership history because you don't want to buy fake stuff or you buy something that was stolen in the black market and then you end up in trouble. When you sell it, you cannot sell it. So that's why you very important to really do your research before you buy a piece. And also, the fifth thing you want to do is verify authenticity. We talk about it. It's a very critical thing for higher value item, authentic certificate or authenticity, review, provenance record, use professional appraiser because you need an appraiser to appraise how much it costs. You don't want to go to the next door neighbor and at least talking about, oh, this might cost this. No, you want to go to professional. Verify grading your card, cramp, and comic book. So definitely you want to be make sure all your stuff is certified. And like everybody else, like every other investment you do, as collectible or art, you want to make sure you focus on quality. So our higher quality prices generally hold higher value. So better condition, you want to look at limited price supplies, strong historical significance, well-known creator or brand, a museum qualified item often outperform several lower quality purchase. So if you're buying at the museum, some type of auction from the museum, usually those help higher value because guess what happened? Those museum already did the research for you. So that's why we encourage everybody to do their research, know where they're buying their collectible. A protect and store property. So make sure preservation affect value. For example, climate control storage for art, safe deposit box for coins, protective cases for trading card, specialized storage for wine. So if you definitely you cannot just buy a piece and leave it in your basement like nothing. You have to make sure what the condition is. That's why you go to professional to tell you about those stuff and you do your research. And also ensuring valuable assets. So as value increase, obtain collectible specific insurance. You will have to have insurance, guys. If it's worth a lot of money, make sure you got a lot of your insurance coverage. Keep detailed record and photograph. Make sure you got that on the record. And also, as you go along, you're building your portfolio. Make sure you monitor the market trend because as any other investment, technically collectibles go up their value, but you never know. So go to the auction and look at the auction prices, collector demand. Maybe at certain time there's not too much demand, and then you asking for 10 times the value of it. That's not gonna sell. Actually, it's bad. So always look at emerging trend. Market can go through multiple years, boom and burst. So you just never know. Like any other investment, guys, investing in collectibles or art is still risky investment. As always, like we mentioned in private equity, always review your plan, your exit plan strategy. Know when and how you will sell. That's why you go to the auction, you talk to private collector, you talk to the dealers, go to the online marketplace. Selling can take weeks, months, unless unlike stock that can be sold immediately. So if you buy a stock, you can just sell it. But guess what? If you have a collectible, you don't know when you're gonna sell it. It might take a long time. So that's why you don't need to be buying a collectible with your own money, like with the only money you have, because those things take time. If you cannot eat and then you have a big collectible, guess what? You want to sell it and you might lose money on it. So that's why you do your research, keep yourself invested, and know what you're doing. So way to invest without buying physical item, even if like for example, even if like you decided not to invest as a physical item, so you can do other way. There is other ways you can invest in those collectibles. You can gain exposure to platform that offer fractional ownership of collectible of art. For example, some website like Masterwork for fine art. Guess what? Instead of buying the whole art, you own piece of it. You know, so you can also go to another website called Collectible for sport memorandum. Those platforms allow investors to buy high value asset rather than purchasing the entire item. So if you are starting right now as a beginner, guys, and you wanna get a piece of art and you don't have the money, you might go to those platforms and try to own piece of those things. So definitely do your research. So the risk is, when you invest in any collectibles asset, is counterfeit and fraud. There's a lot of fraud and counterfeits going on in those assets. You got storage and insurance costs, so you have to pay for insurance when you have those things. It's low liquidity because you cannot sell it. you know High transaction fees. Those collectibles, you're gonna pay a lot of taxes and stuff like that on them on the sale. Market taste can change, like any other asset, things can fluctuate. So there is a guarantee of return. We'll say like, the time that they want something, the other day they don't want it. So it's like any other asset, guys. So for beginner strategy, I will say for the first time investors, pick one niche. If you look at sport card and or watches or art, invest for about 500 to 5,000 initially. Buy only authentic seeded items. So buy only where things they give you the good authenticity. Hold it. I will hold it for 5 to 10 years. Normally, that's why investors, expert are recommended if you're gonna invest in art. Reinvest profit gradually as your expertise grow. So unlike stock, success in collectibles and art often come from specialized knowledge. The more expertise you develop in a niche, the greater you can identify valuable opportunities before broader market does. So definitely your expertise, that's what it comes down to. Don't come here and talking about like, oh, I want to become an investor and I want to do this, I want to do that, while you don't do the work. So your expertise, that's what's gonna make you and any other market and anything you do actually in life. You need to do the work. You need to study, guys. That's why we have 15 video guys for you on our YouTube channel to break down the investment, the investment code, so you can start investing. So now there is no excuses. And this is, with that being said, we are going to end our series today. So as far as it's have been a great pleasure for me to be here, every single week. I, as a very busy professional, I think it was very satisfactory for me to be here every single week to share with you guys, the possibility of investing. I'm a late comer when it comes to investing. I wish when I was 2 years old or 1 years old, somebody will teach me how to start investing. I'd probably be like a trillionaire right now because I developed investing the hard way. And guess what? You don't need to go through what I did at the beginning. So that's why for the past 15 week of the series, we have been talking about how little you can start to invest. We demystify what it comes to investing. Despite what many people may think, I strongly believe, like, for example, investing, for example, in the stock market is one of the most powerful wealth building resources out there. But a lot of time, a lot of people, they think they are not enough. And that's what we have been doing here. We make sure you understand in the series that you don't need to start big. You can just start running with few dollars. As long you're learning, as long you're committed to stay in the market and learn, and that's what matters. And that's what I've done. At the beginning, I start investing, and I'm like, okay, I'm start losing. I was about to quit, but guess what? I keep pushing. I'm like, man, if you work for somebody, you have to work for me. And I keep pushing, I keep pushing. And today I can tell you, I've been investing and I'm very glad that I did. And that's why I don't want you to miss the opportunity to start investing and change your life journey. And because me personally, I wish when I come to the US about 20 years ago, coming from a country like Haiti, with nothing, I wish like somebody would tell me, hey, invest in the stock market, then I would be better off. Because guess what? When I come in, unfortunately, I didn't have nobody who would tell me about investment. All the people, the few people I know in this country when I came, they were not investing, they were just working. And then every day I see them like complaining about their money, financial stuff. But guess what? I had to go and invest. I had to go to learn about investment. As we conclude this series, remember that financial freedom is not a destination reserved for the wealthy. It is your journey. It's available for anyone who's willing to learn and plan and take action. That's the key. You have to learn and plan and take action. This is a journey. So you don't need to be born rich. You don't need to be perfect salary to have a perfect salary. You don't need to time the market perfectly. What you need is discipline, guys, consistency, and to courageously start, especially if you haven't started yet, guys. You have to have that courage and be like, you know what? I'm gonna take the risk. Every dollar you save, every investment you make, and every financial decision you learn is a step toward building the life you want. The decision you make today can create opportunity, security, and freedom for years to come. So that's why we encourage you tonight, guys. If one thing that I wanted to remember is start where you are, use what you have, stay committed to your goal. Wealth is built one decision at the time, one investment at the time, and most importantly, one day at the time. Your journey to financial freedom can start now, tonight, as we leaving the series, guys. Invest wisely, stay patient, and never stop believing in your ability to create a better financial future. Thank you guys for being part of this journey. For the people who just come in and out, for the one who just been there with us since the beginning, and for the one who's gonna watch the series on YouTube or want to come back to watch it on TikTok, we wish you all the best. Thank you for making this journey a possibility. The best investment you will ever make is in yourself. Remember that again. The best investment you will ever make in yourself. And your journey start now. And I'm gonna leave you with this. The last thing I wanna say to you is again, the best investment you will ever make, it's in yourself. This was a pleasure, and I will see you next time in the next journey, the next chapter, the next series. This was my time, Elbozo from Gombit Group. I wish you guys the best luck in your financial journey. You can do it. If I did it, you can do it too. If I have to learn with all the trial and tribulation how to invest, if I had to go through all those problems and still make it through the investment side where I'm still learning, you can do it too. Take that decision and keep going. Never stop. Okay? All right. I'll see you next time. Bye bye.